Now, the best investment in the world is the investment in your mind. Hello, everybody. This is Shane Chu. I'm live from the Bursa Malaysia webinar. Now, this is the last webinar for the beginner series in this year. And today's topic is how to invest rationally in an irrational market. And on your screen, we have a renowned author of 5 best-selling books, Pauline Yong, on our webinar today. Hello, Pauline.
Hi, everyone. Good evening.
All right, good to have you online with us. And I want to thank all of you for tuning in online. If you can hear us, please click the raise the hand button. If you can hear us and see our screen, please click raise the hand button so I can see that you are listening. All right, looking at many hands right now. Awesome. You may put down your hands right now. Now, do you agree with me that the stock market is a very emotional market? Now, sometimes,
Yes.
you know, it is not so logical. We can't explain. Maybe we come up with good news, but then it got sold off instead, and the share price go down. And sometimes it's a good result, but then because of external environment, people still sell down the shares, okay, because of a bearish sentiment. So we have to constantly navigate in a market where it is sometimes not logical but very emotional. So that's why today it's very important for us to learn how can we invest rationally in an irrational market, and by Pauline. So as usual, disclaimer, whatever we share on this webinar is only for educational purpose. In no way that the speaker or us give any recommendation to any buy any company or sell any company share. If you decide to do any trading or investing, you do it at your own risk. Okay. So as you've seen today, we come to the last session of the beginner webinar, but no worries. Next Tuesday, we still have a Chinese webinar series organized by Bursa Malaysia called News Analysis. In Chinese, is read by 消息面分析. Okay. Then if intermediate, it will be the 3rd Tuesday of the month, but this year we are done with the intermediate series. Now, it gives me great pleasure to introduce the speaker on your screen right now, and she is Pauline. All right, she is the managing director of Sigma Wealth. Sandira Berhad, she's a CFP, Certified Financial Planner, and a licensed financial planner with Securities Commissions, CMSRL, and the Bank Negara licensed financial advisor. Okay, she has been in the training industry for more than 20 years, and she was an economics lecturer for 16 years, and now she's a course facilitator for the FPAM CPE courses. She has published 5 investment and financial planning books, in which I think I have a couple of them. And thank you so much, Pauline, for giving me your books. And she's also currently a regular writer for various magazines and newspaper. And she's also a regular commentator for City Plus FM radio station for every Wednesday morning for Stock Market Outlook. She got an MBA in finance from University of Leicester, UK, and BBA in finance from York University, Canada. Wow, very highly qualified. And in addition, she is also a certified chartist, CFT in Malaysia, and a member of the Society of Technical Analysis, UK. So without further ado, let me hand over the session to you, Pauline.
Hi. Good evening, everyone. Yes.
Right now.
Need to share the screen first, right? Yeah.
You are right.
Okay.
Yes, we are seeing your screen right now.
Yeah. Okay. So good evening, everyone. So thank you for having me. So today is a very interesting topic. It's about psychology of investing. This topic, in fact, not many people has actually talked about it, because usually when people talk about investing in the stock market, they talk about fundamental analysis and then they talk about technical analysis. And while the psychology part of it, not many people actually talk about it. In fact, this psychology part, right, is actually very, very important when you are investing. Either you are investing as a long-term investor or you are doing a trading as a trader. So today I'm going to approach this topic in a different perspective. So first I will look at it from the theory part. So I will look at what is the efficient market hypothesis and the various theories about this psychology part, and what drives the investors' behavior. Then I will look into the psychology part of our individual investor. Okay, what went inside our mind that caused us to be emotional. Okay, and then of course towards the end, second half, I will also introduce to you some of the ways where we can overcome this psychological mental behavior, like a mental bias that towards investing, and how we can overcome the mental bias, and so that we can invest with a more successful. Okay, so today's agenda, we have this is today's agenda. So I will go right into the efficient market hypothesis. For efficient market hypothesis, I'm sure a lot of you who are the finance students, you have learned about this theory in your school. So
yes,
when you,
I also learned before.
yeah, yes. So when you learn this, right, would you ever question whether is this a theory applicable in our real world, real financial market? Did you ever wonder, is it true? So actually,
Half true.
Yeah, half true. Okay, because if you really believe that it is true, it means that the stock market is really random walk. There's no way you can make money in the stock market, and in a perfect efficient market, there's no way you can make money. So that's the theory. But however, we can see a lot of hedge fund managers, Warren Buffett, and a lot of successful investors. In the long term, they do make money in the stock market. So that means maybe perhaps our market is not that efficient. Okay, so basically there are three forms of efficiency. So the first one is called the weak form. Okay, weak form, which means that we can say that maybe in a developing country like Myanmar or Vietnam, whereby the stock market is only like very few stocks, and then the efficiency is very weak. Okay, so that means people who has a bit of information about fundamental analysis or technical analysis, they can make money in the stock market. So that means the market is not efficient. Okay, and then while the next level, semi-strong form, it means that the market is somewhat efficient, whereby all the public information is reflected in the stock market. So if you, however, if you have like a technical analysis, you can still make money in the stock market, or fundamental analysis, you can still make money in the stock market, despite there's all the information is reflected in the stock market. So, but however, if you do have like additional skill like technical or fundamental, you can still make money in the stock market. So I believe currently in a lot of the markets, right, we are semi-strong form, including Malaysia and Asian markets. And for US market, I would think that it is considered strong form. Okay, whereby under the strong form, right, then there's another extreme, it's called a perfect. I don't see there's any markets in the world is called a perfect efficient. You cannot have a perfect. It means that it is totally no way you can make money. But I do see that you can make money in the stock market. So either you have the strong form or semi-strong form in the stock market. So for strong form, it means that if you have that extra knowledge, like private information, or certain info that other people that do not have, then you can make money in the stock market. Okay, so this is the efficient market hypothesis. The theory was developed by Eugene Fama, and then it was developed in the 1970s. Okay, it was quite some time ago. Then come to this Andrew Lo, the MIT finance professor. So he came out with this idea. He said that perhaps the market is called adaptive market hypothesis, whereby due to the extent that market is so dynamic, okay, the market is so dynamic that the market itself will evolve, and the investors itself will evolve together with the market. So that means when you see that the market behave in certain way, then your investors' behavior, you will also behave in a certain way. That means you are actually adapting to the environment, in financial environment. So for example, you look at the US stock market. Every time when the US stock market have like a 5% fall, and then everybody was scared. And after a while, then you see the stock market recovered in a short period of time, and then it went up to higher level, another historical high level. So you can see that the every time when the stock market dropped like the most 10%, and then it will rebound, and then it went further. So people look at this situation repeating and repeating, and you look at the volatility maybe getting lesser and lesser, and then people get like contented over this kind of environment. Maybe they can accept higher and higher risk, although they know that the price is very high already, but because of the market behave in such a way that every time when it fell a little bit, then it rebounds and then it went further, then although the price keep going up, but people are willing to take that extra risk without them knowing themselves. It's like they are being involved in this financial environment. Then they take that extra risk every time when the market go higher. They said, okay, so what? The market go down and then it will recover. So I'm not afraid. So I'm willing to take the risk. So they are willing to take the risk without them knowing that they are taking more and more risk in this kind of environment. Okay, so this is what Andrew Lo is promoting, which is called the adaptive market hypothesis. And this linked to the next topic, which is called the behavioral finance, whereby we look into the how individual investor make rational decision. Okay, let me ask you, Shane, are you a rational investor?
I would believe I'm a rational investor.
What do you mean by what's your definition of being a rational investor? What's the criteria? Like how
like
do
we do our investment decision or trading decision based on logic and facts, based on what we judge, but not based on emotional impact. Yeah.
Okay, so yeah, that's pretty much the definition, which means when you make a rational decision, you are based on probability. You have a probabilistic mind that what's the probability of this worst case scenario or best case scenario. You have the estimation of what's the probability.
Yeah, I'm a probability guy. In fact, when I come to trading, I'm a probability guy. You know what's my background? I study actuarial science. So I'm the
no wonder.
So I'm the probability guy. So when it's time to cut loss, I cut loss already.
Yes, you're the risk expert. If in that case, you are the risk expert because you calculate all the risk in quantify all the risk so that you know that whether this risk it's worth for you to take on or not. So that means you are a very rational investor. But however, in when you compare to other people, sometimes perhaps when we make certain decision, we may not be rational. That means we may based on our intuition. Intuition meaning that your sixth sense, or like your intuition, because sometimes you have a gut feeling. Okay, you feel that okay, the market, although the market is bullish, but then you have a gut feeling. Okay, this market may not turn out. I think it may turn bad soon. So then you do some decision. So this kind of a decision is called a heuristic decision. That means you based on intuition. In life, there's no right or wrong. Actually, there's no right or wrong. In fact, in life, when we look at what we do, for example, there's a ball throwing at you. Okay, when there's a ball throwing at you, automatically you will have to catch the ball without knowing or without having to decide like what's the angle of the ball. Shall I turn my hand to shall I turn my head to the 45 degree, or you don't have to think so much because the ball is throwing at you, and then automatically you just have to catch it, or you have to throw it away. So it's an auto kind of action. So this kind of instinct, right, is called heuristic decision as well. That means it's like a very quick decision. So for there's a professor called Daniel Kahneman. So he came up with a book, Fast fast and slow thinking. So that means he said that our mind, we have two types of thinking. So one is a fast decision and one is a slow decision. While the fast decision is called the heuristic, whereby we make decision in a quick instant. So it could be based on our experience. Whenever we see the ball throwing, then you have to do something. So it's based on your experience, then you have a quick response. And a lot of doctors, when they make a certain decision, based on their past experience, the patient come and then they see that they have this kind of a symptom, and then straight away they can give a diagnosis. So that means it's quite a quick decision. However, slow decision, meaning that you need to have weighed the pros and cons, and then you need to spend a lot of time weighing the pros and cons, and then come up with a final decision. So for investing, you can apply both. I'm not saying that all the decision for investing has to be rational, then it's the right one. Not necessarily. There are traders that really based on intuition, and it is not wrong. It is still correct. It's just that whether you are able to quantify your risk, and then whether you are able to minimize your risk. So that's the most important thing. Okay, the decision being made is there, but then on another part is your risk management, whether you are able to manage your risk. So that's a very important thing for the investors or traders. Okay, so for market sentiments, in order to see what the market is telling us, because when you are investing, right, there are two things that is unknown. Okay, one is the market environment. We do not know the market environment. And number two is our behavior, our psychology, our emotion. Because our emotion, we cannot for sure guarantee that we will behave in a certain manner. Sometimes we will behave different than what we want us to behave. So that means there are two things that here when we talk about psychology. First, you need to manage your own psychology. What is inside your brain? You need to manage that. Number two, you need to manage your environment, because the environment also has a crowd psychology that you need to manage and you need to monitor, because you must know that what is happening in the financial market so that you can make a better decision. So therefore, in order to know the market well, there are a few indicators that you can follow. So these are common indicators that you can follow, like for example the volatility index. They call it the fear index. You can Google it, volatility index, and then you can see the index. When the volatility index is high, it means that people are scared. Okay, the people are selling, so the stock market will go down when the volatility index is high, and then vice versa. And then you will see that the Nasdaq, the S&P 500, the Dow Jones Industrial Average, these three index, usually the first thing when you wake up in the morning, when you want to do trading or you want to do investing, that's the basic index that you have to look up for, because you want to know that what's happening for the US market overnight, so that you know that today the Asian market will behave according to the US market. Usually it will follow. Then you have the advance versus decline, whereby how many stocks in the stock market are moving in a positive territory and how many stocks are in a negative territory. So if there are more stocks advancing than decline, that means it's a bullish market, and vice versa. And then of course you have to look at the regional stock market indices, for example the Hang Seng, Nikkei, Straits Times, KLCI. So the regional market, you have to look at it as well. So all these will give you a sense of market breadth. They call it the market breadth, or the sentiments of the market. Okay, so this will give you like a very rough guide on the general market sentiments of the stock market. Okay, however, if you want to look at the individual stock, it will rely on a technical indicator, where I will introduce to you later towards the end. Okay, so this one is just a look at the purely the market sentiments only. Okay, not so much of an individual stocks. Okay, then investors rationality. So rational means investors do not systematically overvalue or undervalue financial assets in light of the information they possess. Okay, so if everyone is rational, no bargains in the market, and the market reflects the correct prices. So this is what in theory means. So if everybody is assuming to be rational, everybody make the right decision. So there's no bargain. You can't make money in the stock market. The market become a perfect kind of efficient. There's no way you can make money because everybody behaves so rationally. Okay, however, in the real world, you can see that our stock market is not behaving rationally. It's so emotional and it's very volatile. Okay. Now there's one experiment I want to introduce to you, this investors' rationality through this example. So for this experiment, the researchers, they did one experiment with two groups of people. Group one is a normal people like me and you, normal, and then group two are those brain damaged individuals due to tumor removal or accident. So that means a part of their brain is being damaged, and then there's a removal of the tumor. Okay, now so they're gonna play a game. So they play a game. So this game is like this. It's a head and tail lah. So it's like a coin, 50-50% kind of a game. So head or tail. So if you guess correctly, you can get 250. And then if you guess wrongly, you will lose $1. Okay, so the game is that you win, I give you 250, and then if you lose, you have to give me $1. Okay, so this is the game. And you guess what? The outcome is that, okay, if a normal person, if it were you, how would you want to play this game? Would you want to keep playing, keep betting this game, or you want to give it a pass?
I will play lah.
You play, right? All the time,
Yeah.
all the chances. You will not give any pass.
Yeah.
Okay, why? Okay, why?
Because the expected outcome is positive.
You are really a math expert. Yes.
Yeah,
but then
definitely.
Yes, because it's due to the, if you look at the expected outcome, if you guess correctly, you can get 250, and then if you lose, you only lose 1. So the expected the outcome is more than your losing. So
this is a no-brainer to me. Definitely play.
yeah, but you know what? The actual experiment, when they carry it out, a lot of people, the normal people, right, when they don't feel lucky, they will pass. They will say, okay, I don't feel lucky, I'll pass this time. But then for the brain damaged people, right, they will keep playing. They want to maximize each game because they want to maximize the money. So
really,
you can see
normal
that,
people want to pass. How many samples do they run the experiment on?
I wrote that example in my book called I Love Rational Investing. It's inside the book. I forgot how many, but it was a real experiment. And normal people, yeah, because sometimes when you don't feel lucky, so I pass because I don't want to lose money. So that's a normal people that will behave like, say, I don't want to lose money. So that's why they pass. But if you were to calculate, in fact, this game is to your advantage because the expected payout is a positive expected payout. Okay, so this is how people may behave irrationally sometimes when it comes to money, because when it comes to money, everybody are like emotional. If it's not money, I think people, yeah, if it's not money, right, if there's no money involved, people can behave more rational. But once the money factor come into the picture, everybody behave irrational. Okay, so then this one is the mental bias. There's a statistics research done by the CFA Institute, and then they said that majority of the people, the mental bias that they have, this bias is called the herding. That means they like to be influenced by the peers, like they will follow. Okay, so majority of the people, like 34%, are like that. And then 20% of the people, they have this confirmation. That means they look for belief. That means if I think the market is a bullish market, I will have to look for the newspaper, I have to look for the information, ask my friend, and then see if whoever has the same view with me, and then I agree, and they also agree, and then I'll seek those that agree with mine, and then I will say, okay, majority follow, confirm with my idea. In fact, there are people who don't agree, people who are agree, but you only look for those people who agree with you. So that means you are being biased already. Okay. Then you also have overconfidence. So this is quite common. And then availability bias. Availability bias meaning that what happened in the most recent experience. For example, there's a plane crash. Okay. When there's a plane crash, immediately for the next few weeks, nobody dare to aboard the plane because they're afraid. So this is called availability bias. That means they are being biased by a certain event that happened in recent case. Then you have the loss aversion. That means you're scared of losing money, and other. So these are the mental bias, and a lot of people we're having this. Okay, and it is quite normal. It's not like abnormal. It is normal that you have this bias. So now let's apply some of the theory of this behavioral finance, whereby I will ask, why are investors like to sell the winners and hold on to the losers? Which means when you have a portfolio, all right, you have a portfolio, and then you have some stocks are performing very well, and then some stocks are maybe lose 50% or performing very badly. Okay, so what is the likely that you will do? Most people, when they need money, they will sell the winners first, because the stocks that already given you the profit, they will sell those profit. Whereas the stock that are in the paper loss, they will keep it. They will hold on to the losers. So therefore, I'm going to use this prospect theory to explain why are people behaving like this. Okay, I'm sure I'm also one of this kind of behavior. A lot of people are like that. So this is the prospect theory. It's called the prospect theory. So suppose you are given the following options. Okay, so you have two options. Number one is that you can win the 1,000 instantly. So that means you are given an option. So either you will take that 1,000 and then put it in your pocket and then you go, or number two, you take a bet. Okay, either you win 2,000 or you get nothing. So which option would you choose?
Okay, I think it's open to everybody, right?
Yeah.
So if you're online, please type you take one or you take two. Okay, let us know. The group chat. Would you want to take option one, or would you want to take option two?
Option one meaning that you're given 1,000, or you want to take that 1,000 straight away and then you go, or you want to take a bet, because if I take a bet, I still can get 2,000, or I get nothing. So which option would you choose?
Let me see. Wow, we have above 50 responses already. Okay, giving you more time. I personally, I'm a math guy, like, you know. Option one.
So otherwise your answer will be
option one and option two give the same expected outcome. Outcome lah. Yeah. So but I will be slightly more inclined to take option one for me lah. For me.
Yeah. What about the audience?
Okay, I think we have waited enough. Wow, there are let's see. I think there are probably slightly above 50 responses. Let me see. Majority pick one.
Yeah. Yeah, so in fact, when this show to a group of
probably 20%,
right?
20% pick two, 80% pick one.
Yeah.
Yeah, and someone comment that a bird in the hand is worth two in the bush.
Oh, okay. I don't know what that means. Okay. Anyway, so a lot of people, they take the option one, because when you see the money, you want to take the money immediately. You don't want to take risk because you are scared of you may lose, right? So therefore, in a positive environment, right, you will take that money. Okay, so now I'm going to test you another question. So another scenario. Later I will tell you the answer. So this you play this game first. Suppose you are given the following options. Okay, now number one, option one, you will lose 1,000 instantly. So straight away, I'll take 1,000 from you. Okay, you lose it. Or number two, you take a bet. Either you lose 2,000 or you lose nothing. Okay, which one would you choose? Would you want to choose you lose 1,000 immediately, or you want to take a bet? So perhaps either I can lose 2,000 or I lose nothing. So
Okay.
the audience,
Wait, giving them some time to feel. I have seen many responses coming in. Yeah. Personally, from mathematics standpoint, the expected outcome is still the same, negative
yeah,
1,000. But we will see.
A lot of people in the experiment when Professor Kahneman was giving to a group of students, and majority will take option two, because how about the audience? I want to see the audience. Are they also taking option two, or they are rational?
We have about 60 responses plus. I would say that, let me count. Well, I am from the screen that I see, I would say that 70% pick option 2, 30% pick option 1.
Yeah, that's normal, because when this was done by Professor Kahneman, who's a Nobel Prize winner of his behavioral finance theory. So he did this, and then majority would choose option 2, because when you are facing this loss, okay, when you are facing losing money, right, you are scared of losing money, so you want to take risk. So when you take a bet, meaning that you want to take risk. So when you are under the losing environment, right, you want to take risk. Okay, so because if I take risk, I may not lose. So that's what you say. Then in the sure win environment, you want to take the money off the bet. You don't want to take risk because you want the sure gain. Okay, so then this explain, actually these two, because we are talking about the 50-50 chance, the bet is 50-50 chance. So the expected outcome is the same actually, because when you take a bet, right, you'll use 0.5, which is 50% chance, times 2,000, and that will give you 1,000. So, and this one also same thing, 50% chance of losing 2,000, right? So 0.5 times 2,000 will give you 1,000 also. So that means the option 1 and option 2, the expected outcome is the same. Both are negative 1,000, and this one, both are positive 1,000. But how come majority of people sway towards the other option? So that's because when you are facing losing money, right, you rather take the risk. Just like when your portfolio, you have these shares that are losing paper value, that means you are losing like 50% on paper. So you don't want to realize the loss, so you hold on to the loser. Okay, but you didn't. In fact, if your stock is really not a good stock, what about, have you ever thought about selling the not so good ones, and then you turn that money into buy good stocks, and then the good stocks will grow faster in value? So isn't that more rational for any investors? Because since the stock is not making money for you, so why don't you just sell it and then cut loss, and then buy another good ones, and then let the good one, make the profit for you? So that's why a lot of people, they rather hold on to the losers, because they still hope that one day this stock will go up. Okay, if it's a blue chip stock, yeah, maybe it will go up. But then if it's a penny stock, I'm afraid when it is down, it will be down for a long time. Okay, unless it's a blue chip, okay, then it will be different. Okay, So this prospect theory illustrate how our human psychologically we are scared of losing money, okay, which is perfectly normal. So it's just that now that you realize that we are scared of losing money, so on another side of it, you will have to think that, okay, how do I overcome it? Perhaps I should think rationally. If this stock is not making money, and then the principle or the fundamental value has changed, perhaps I should sell it and then turn on to a better fundamental stocks. Okay. So this is the diagram that illustrates the prospect theory, which means, let me use a highlighter. See if I can use highlighter.
Can.
You can. So you can see, yeah. So this is a highlighter. I can highlight to you that for 100, positive 100, just now we have a positive 1,000 and a negative 1,000. Okay, let's say we have a positive 1,000 and a negative 1,000. So our positive 1,000, the expected value is like here. But the negative 1,000, right? Our expected value is like so much worse feeling, like you feel so much worse off. So although it's still 100, 100 or 1,000, 1,000, but in terms of positive value, you feel your expected value is this much. However, the negative value of that same amount is so much worse. Okay, so much worse. So that means
when you make 1,000 ringgit, you will feel this much of joy. But when you lose 1,000 ringgit, you will feel this much of pain. Okay.
Yeah, terrible feeling. Your feeling is worse. Okay. So that's how the prospect theory illustrate using this diagram.
Let's ask the audience. Do you agree? Do you agree with this? If you agree, please type yes. If you don't agree, please type no. Let's run a poll and see what they think. Oh yeah, many totally agree.
Yeah, totally agree. Yeah.
Yeah. So the experiment is correct. Majority say yes.
Yes. Okay. So now the next question is, do you think heuristic can make money? So heuristic meaning instinct. Do you think instinct can make money? What do you think? That means fast decision. Do you think when you make fast decision, you can make money?
No, it comes with good market experience, then your intuition becomes very sharp. Like you see this kind of chart pattern, you will know what is the likelihood of this to go. Is this considered facts or this is considered emotional? Sorry, I'm not behavioral finance
already. Exactly. What you say is right.
I mean, it's like mood lah. Like today, I wake up in the morning and say, okay, today Penta Master will go up. Okay, so I buy.
No, I'm not saying that one is okay. I'm saying that what the just now you say, when you see the chart pattern, when you see this chart pattern, automatically you will trade a certain manner. That one is heuristic. I mean, facts. Yeah. So that means you are so familiar, your execution, your trading, you are so fast that you are so familiar with the pattern already. So whenever you see this, then you will behave in a certain manner. So when you see the price go beyond this price, then you long, and then go beyond that you short, and then you go long and short, and then automatically you see that means you see this, you recognize the pattern, then you trade accordingly. So then this one is called heuristic. So in fact, heuristic can make you money. It's just that whether you can apply correctly and whether you can manage your risk properly. Okay, depends on your experience. However, if let's say you have zero experience, you come straight like empty into this stock market, and then you have no experience, and then you look at the chart move wildly, and then you try to decide whether you want to have a long or a short position, then you are like tikam. Then that one, although you are like making a fast decision, you just trade accordingly, but then that one is no risk management at all. That one is highly risky. So you get what I mean? So that means although you can have this heuristic or instinct kind of a behavior, but you must accompany by your risk management. If you have a proper risk management, that means you are safe, you're okay. You can by all means use heuristic to make money for you because you have the risk management in place for you. However, if you do not have it, and then you just want to tikam and then use intuition, and then you just, like what you say, you wake up in the morning, you feel that Penta is going to go up, then you buy, that one is highly risky. Okay, so in fact, for what I want to say is that although we understand that we have this mental bias, okay, we will follow the herd, we will overconfident and things like that, but following the herd doesn't mean that it's always wrong. It could be you follow at the right time, then it pays you well. Okay, for example, you follow people, and then while this people is like beginning of the trend, you follow right at the beginning of the trend, then you follow, you are right on. That means you follow at the right time. However, when people are already trying to come out from the market, and then you want to go in, and then you want to follow, then you are following at the right, you are following at the wrong time. The market go down, and then you are just about to go in. Okay, so it depends on your position, and also it depends on your risk management. Okay, so in terms of whether rational, irrational, what I want to say is that the most important is that you must understand yourself, and then you must understand the market. Okay, so that's why bring to the second part of the webinar, whereby we will talk about how do we overcome the irrational behavior. Okay, so how do we overcome? So actually, I will say that there are two things. I will have to keep repeating these two things. First, you understand yourself first. Number two, you understand the market. Okay, so just these two things. You understand yourself, and then you understand the market. So this by doing this, you can minimize your risk, and then you can overcome being emotional trading. Okay, so how do you understand yourself first? So very first question you have to ask yourself is that how much risk am I willing to take? Okay, how much risk? Because very often when you go into the stock market, right, a lot of people, they have a very positive kind of feeling. So most of the time when people go into the stock market is when they feel that the stock market will continue to do well, and then they will win eventually. Okay, so that's the common psychological thinking when you want to go into the stock market for a normal investor. Okay, for a normal investor, because who wants to go into the stock market where you feel that you are going to lose money? Nobody would want to go into the stock market when you feel that you are going to lose money. But however, if you have in this environment for a long time, right, sometimes there's no harm feeling that. Okay, when even though you feel like you are losing money, there's no harm feeling with carry on with this feeling, and then you enter a long position. There's no harm, because who knows, in the end you may win. Okay, provided you have your risk management is in place. Okay, so therefore the very first thing is that how much risk are you willing to take? Okay, if you are not willing to take much risk, like you are the kind of person whereby if you lose like 10% or even 20%, 10%, 20%, you feel very heartache, and then you cannot sleep well, you cannot eat, you cannot carry on with your normal task. That means you are not suitable in investing at all. You are not suitable, or perhaps you are more suitable in another type of investment instrument. Perhaps unit trust investment or regular investing instrument is more suitable for you, and not like one lump sum kind of investment strategy is suitable for you. You are more suitable for the regular investing type, whereby you just invest on a regular basis, whereby take out your emotion. You don't have to feel whether it is the right time or it is not the right time. You don't have to feel that. Okay, so doesn't mean that if you cannot take much risk, you will be shunned away from the investing in the stock market. No, it's not like that. You understand that you cannot take much risk, fine. Then you go for another type of strategy, a regular kind of a investing strategy, or you buy unit trust, whereby this fund house is very famous for their fund management skill. or their fund manager reputation. So you buy a good fund, and then you have a rest of your peace of your mind. Okay, so you can change your strategy to another type of strategy. Doesn't mean that you have to invest personally on your own. Doesn't mean that. Okay, if you're not suitable, then you have to switch. However, if let's say you are able to withstand the loss, like you lose 20%, even 50%, you are okay. Okay, you are okay with it. So that means you are the kind of person that you are able to take risk. So then you can take higher risk. Okay, but of course, every time you must have the risk management in place. You must know what is your cut loss point. Okay, so that's number one. Understand yourself first. Then number two, understand which type of investors are you. So this one we rely on tools. Okay, it's called the financial risk profiling tools. Okay, risk profiling tools. So this one we can get from online. You just Google it. You can Google and then say risk profiling for investors, then you can come up with a lot of tests. So you just take any of the tests. I can guarantee you, majority of you are balanced investors. Okay, that means you are the balanced type. Some of you may be conservative, that means you are scared of losing money, and some of you may be very aggressive, that means you want to take risks. But majority, we will be under the balanced one, that means we are 50-50. So if you understand that you are 50-50, that means what? That means you have to put like half of your money into the equity and half of your money into the income generated instrument. Okay, income generated instrument can be REITs, can be fixed income like bonds, or it can be very stable blue chip stock that give regular dividends. Okay, so therefore this, as long as it can give you a source of income, is considered income, that they will give you income. Of course, the best definition will be the fixed income. That means like a bond fund kind of a bond instrument. Okay, so then you would have another 50% will be on equity. Okay, well, equity you will have to think, okay, shall I go for like a very risky like a forex or Bitcoin, or or penny stocks or technology stocks. So it's up to you. You have to know yourself first whether you are able to take that kind of a risk. Okay, so but as long as you have a balance of in fixed income, and then I think you can allocate some into more risky fund, because you have the income fund to cushion, to give you a basic source of a return. Okay, so that you can cushion your loss, and then you can have a more risky in that the other half. Okay, so that is understand which type of investor are you, and then also you need to know how much financial knowledge do you have. Okay, this one, if you do not have much financial knowledge, then your strategy could be different. Like what I said, if you are totally new, perhaps you want to rely on the fund manager, buy unit trusts. Okay, or you want to buy ETFs. ETFs means exchange traded funds, whereby you buy these ETFs, and then these ETFs will track the index, like the S&P 500 index or KLCI index. It will track a certain index. So this kind of a passive investing strategy is suitable for people whereby you don't want to spend so much time on doing research, but you don't have much time. So you just want like a passive kind of investing style. So you go for ETFs or unit trust. Okay, so however, if you have more time and then you are very eager to learn about investing, so by all means you go for active investing, whereby you have to look at the annual reports every quarterly. You have this earnings report, and then also you need to look at the economic indicators, financial environment, what is happening around the world, even political news. Okay, what is happening in the regional politics, and then even local politics. All these you have to be aware of, so that you are being aware of the environment, of the financial environment, what kind of a financial environment it is. Okay, then you are able to make better decision. Okay, So all this will depend on how much financial knowledge you have. Then also you need to understand the time frame, the horizon, how long am I going to invest? Okay, is it for short term or is it for long term? If it's for short term, perhaps what kind of instrument is suitable? Is it the fixed income or those trading style? Okay, if it's a trading, perhaps you might need to have more info, like your knowledge, technical analysis knowledge or fundamental analysis knowledge, because in order to be a trader, you definitely need a lot of financial knowledge. Okay. However, the next one is a lump sum or regular investing. This one, I can show you this diagram whereby you can see that the blue ones are the regular investing. Okay, this one is the regular investing whereby you can see they start from a very small amount, because regular meaning that every month you pay like invest like 200, 300 or 500, a very small amount. So that means you start from small. Then in the end, you will increase. As the years go by, it will increase. Okay, while the lump sum is like at one like a one lump sum of investment is like a 50,000, 10,000. Okay, so your starting point is a very high starting point, and then it goes like that. Okay, now when you compare these two red lines and the blue lines, you can see that which line is more volatile. The red line is more volatile. You see, you go up here and then you have a sharp fall here, and then you go up again. Whereas the blue lines is more smoothed out already. Okay, it's more smoothed out. That means the volatility has reduced over the years. So therefore, it tells you what? It tells you that if you are comparing lump sum investment and regular investment, how is the return like? Return like, we can't compare apple to apple because the amount of money is different. This one is like you started with like 100, 200, that kind of amount, and then this one is like you have a one lump sum. So monetary wise, value wise, it's not on the same pace. So, but what we can see is that we can see that the volatility, okay, for these two kind of investment, the strategies, the volatility is different. The lump sum investment strategy is more volatile, whereas the regular investment strategy is more smoothed out already. It's less volatile. So if you are the type whereby you are scared of losing money, and then you do not want to see volatility at all in your portfolio, the regular investing is more suitable for you. Okay, you can apply in the unit trust or you can apply in the stock market. Apply in the stock market is a bit difficult because that requires your discipline. So that means every month you decided that month end I will have to invest in a particular stock. I will have to invest a fixed amount of money into the stock market. So that will require some discipline and some really strict discipline, because sometimes when you see end of the month the stock market all collapse, then you feel very scared. Then you are not able to make out that investment that you want to invest in the first place. So if you want to invest on your own, it's a bit tough because of your emotion. Okay, but however, understanding your emotion is also good, because you know that you are going to be scared. So you have to tell yourself, no matter what, I just have to stick to it. So month end, then I'll just be like a robot, and then I'll just invest 1,000 every month end. Okay, otherwise you invest in the unit trust, and then you take up this direct debit automation or whatever. So every month it will deduct from your bank account to that unit trust investment. Okay, then if you look at this diagram, you can see that stock market is always on the uptrend. So this will come to this one is called think long term. That means you want to think long term, and then as you invest in the stock market for a period of a long term, right? Your price is supposed to be on the uptrend. Okay, because so far the stock market that I've seen, especially for whether it's Malaysian stock market or the US stock market, it is upward sloping. However, this upward sloping, you have different angle. Okay, like perhaps Malaysian stock market, the angle is about 35 degree, kind of a slow growth kind of a angle that but it's still on the upward trend. However, if you look at the US stock market, US stock market is 45 degree, okay, and the 45 degree is quite a steep slope ascending. So it is all upward sloping. It's just that whether you have a lower angle or a higher angle, okay. So this is how the stock market behave in long term. And then number two, just like I said, there are two things you need to take care of. One is that your own emotion. So just now, all these are to understand your own emotion. So we look into whether to know our time horizon, whether you want what kind of investment strategy, and then how much financial knowledge, and then what type of investor. All these are talking about you yourself, how you're going to do, okay, as an investor yourself. So focus on yourself. So the next one I'm going to talk about is the market. Okay, now we need to understand a bit about the market as well. So after we understand ourselves, then we need to understand the market. So in order to understand the market, the very first thing you need to know is diversification. This is the very first topic that you need to understand. Diversification. You have a portfolio, and this portfolio has to be diversified into various stocks, and there's a calculation. In order for a portfolio whereby it is a optimal portfolio, whereby it is well diversified, okay, how many stocks you think should be in that portfolio? The statistics shows that usually it's about 15 to 20 stocks, okay, 15 to 20 stocks. That is the number of stocks that should be in your portfolio. That means that it is well diversified. So that means what? That means you have to buy about 20 stocks, and these 20 stocks will be from all different industry in the stock market, because you have so many industry, right? So you have to buy 20 stocks all over the from different industries, so that you look at the diagram, because in each of the individual counter, right, you have two types of risk. One is the market risk, and one is the unique risk. The market risk is like your economy data, your political scenario, US market, the general kind of market risk that nobody can avoid, okay. Another kind of risk for the individual stock is facing is a unique risk that is unique to the individual stock. This individual stock or unique risk can be diversified. For example, plantation has plantation risk, consumer has consumer risk, banking stock have banking stock industry risk. So different industry will have their own unique risk. So if you were to combine these different stocks together from various industry together, right, somehow you can neutralize, okay, neutralize each other's covariance, like their relationship, because stock A and stock B, they have their co-relationship. We call it the covariance, or the relationship between them, okay, or the beta between these two stocks. So if you can have more stock inside, right, so you are able to because some covariance or co-relationship is a positive relationship, like stock A and stock B can have a positive relationship, while stock A and stock C will have a negative relationship, and then stock A and stock D will have a zero relationship. So we have positive minus negative, and then a zero. All these add together, then your risk become neutralized, okay. And the risk, another word for risk is called standard of deviation, okay. So when you calculate the standard of deviation among the stocks, right, the standard of deviation, when they add all up together, positive, negative, positive, zero, all add all up together, it become neutralized, and then the risk become smaller and smaller. However, you cannot diversify all the risk, because you still have a market risk, okay. So therefore, the meaning is that understand diversification, then you can have a variety of stock in your whole portfolio. Then number two is that you understand the market through the news, okay. A lot of often a lot of investors, a lot of financial gurus, they will say that contrarian investing. So what is this contrarian investing? Contrarian investing meaning that when the headlines in the newspaper all say positive rosy, good, whatever. If you are a contrarian investor, you probably will have to think the opposite. Okay, so shall I sell my stock now? Since everybody is so bullish about the stock market, so you have to think in a reverse way. Okay, or another situation whereby the news headlines say that negative, very bad, it's going to be recession, very negative kind of a news headline. So under this kind of situation, if you want to be a contrarian, you have to be the one that is buying into the stock market. Okay, so therefore, if you want to understand the market, you will know that sometimes when the market is to an extreme over bullish, very soon that it may be reversing, or the market is extremely bearish at one end, very soon that it will be reversing too. Okay, so the thing is that the investors, we all listening to the news, but then when you are overly listening to the news, you may be swayed by the emotion because you listen to the news headline more than yourself. Okay, so for those contrarian, right, they will listen to themselves rather than the news. Okay, so therefore you have to be objective. When you read the news, you read the news as the news, but then you also must have your objective thinking, that the other side of your thinking is that what could be the opposite. Okay, so therefore this is one way to understand the market, by being a contrarian investor. Then also to understand the market through technical analysis. Okay, because through technical analysis, for example, the technical indicators, right, it will give you the individual sentiment of the individual stocks. Just now I said those like an index like S&P 500 index, the US stock market, the Nikkei, all the indexes throughout in the world, those can only give you a general market sentiment. It will not give you individual stock sentiment. If you want to know the individual stock sentiment, you have to look into the technical analysis, have to look into the technical indicators. So here I have 5 technical indicators. There are a lot, there are hundreds of technical indicators. So I will choose 5 whereby these are the very easy to follow. Anybody can follow. So in fact, I have another webinar previously with Busa also talk about in detail about these 5 indicators. So you can re-look into those videos. They are all in the Busa Marketplace. Under the Busa Marketplace, the resources, all the past historical webinars are all kept in the Busa Marketplace. So you can go back there and then look at those videos. So I will not explain the derivation of what is RSI and stochastic. I will explain the application, okay? Because due to the time constraint, I will explain the application, how we're going to apply the RSI and stochastic, okay? So let's look at the RSI and stochastic. So for the RSI and stochastic, if you understand the technical analysis, right, you have to download the software. Okay, download the software. After you download the software, there's a place whereby you have all the indicators. So you just click RSI. Okay, if you want to know RSI, you just click RSI. And then if you want to know the stochastic, then you click the stochastic. So over here, I have RSI and the stochastic below the stock chart here. So for the RSI on default is about 30. It's always 30 and 70. The range here, 30 minimum, and then it's actually from 0 to 100, but then at the 30 they have one line, and then 70 they have another line. But usually I will change the parameter to 20 and 80. Okay, for RSI, 20 and 80, because I don't want it to touch my the extreme side. I don't want it to touch too often, too frequent. So if I change to 20 to 80, right, you can see that my upper range here, it didn't touch very often, and then the lower end also didn't touch very often. Okay, so that I can know when it is overbought and then when it is oversold. So when it is above this upper range, the line here, when it is above it or touching it, then it is overbought. That means very bullish. Yeah, the market is very bullish. So when the market is bullish, could it be that it may be reversing soon? Or when it touching the 20 or the 30 line, that means the market is oversold. Okay, see, the market is oversold over here. When it is touching here, the market is oversold. And then another one is when it's oversold here, it's a down here. And then here, also another down here. Okay, so you can use this as a indicator to tell you what is happening to that particular stock. Okay, because you want to know the sentiment of the stock. So that's one way by looking at the RSI or stochastic. So this one is a stochastic. Okay, stochastic also you have 20 and 80. So when it is above 80, so you can see that above 80, the stock market is going up. Above 80, going up. Okay, and then when it's 20, the stock market is going down. Okay, sometimes when it is going up, it will go up further. Okay, that means when you see that this above 80, right, this stock will continue to go up further. And then when you sell because of overbought, and then you see the stock continue to go further, then you will have a heartache. Okay, but so that's why for overbought and oversold, I usually look at the oversold to get the buying opportunity. But of course, when you have oversold, right, there's a low point here, but it may go down further. Go down further, never mind, you buy some more. Okay, then because eventually it will have to go up, and then when it go up, then you will have to sell. So when you sell it, you have already, when you bought at this level, you bought at this level, and then you sell at this level, you already make the profit. Okay, so I would see that this overbought, oversold, I would prefer to buy during the oversold rather than to sell at the overbought. Okay, because when you sell at the overbought, you can see that the price go on higher, and then you'll feel the heartache. But however, when you use the oversold, you buy at the oversold, you just lower cost, and then when the market turn over, you can make profit already. So therefore, I prefer to use the oversold, okay, rather than the overbought. Okay. Then the next indicator is to tell you the, oops, I got, okay, never mind. I think I should have enough. So the average true range is called the ATR. So this ATR will tell you the volatility, okay, volatility of the stock. So the derivation is something like this. You look at the, for example, 14 days ATR. You look at the past 14 days. What are the day high minus the day low on average, and then you divide it. Okay, on average, the day high, the day low. On each of the 14 days, you sum them up and then you average up, and then that will give you the past 14 days volatility. The maximum equal, it was like that. The minimum equal was like that. So it gives you the volatility. So this ATR will tells you what? Tells you the volatility of that particular stock. Okay, will tells you the volatility of that particular stock. So you can change the parameter. Oh, I want to change to 20 days or the past 5 days. So you just change the parameters. But by default is 14 days. So therefore, you can see that this is the ATR over here, the line. When it is going high, it means volatile. When it's going low, it means low volatility. Okay, so it simply means like that. You just, it's not a buying or selling entry or exit. No, it's not. It's just to tell me the volatility of that particular stock. Okay. Then number 3 is to look at the MACD. Okay, the MACD generally will tell you how bullish or bearish is that particular stock. Okay, how bullish or bearish. So basically, you look at the histogram. Histogram, if it's green color, green, 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 it means bullish. If it's red, 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 it means bearish. It's very straightforward. It's very clear. Okay, you see the green histogram, histogram means the bar. Okay, you see the green bars. Majority, at one glance, you look at it, you see a lot of green bars, that means bullish. And then at one glance, you see a lot of red bars, it means bearish. So over here, it is bearish, and then over here, it is bullish. Okay, of course, you have other things also, but over here for this MACD, I just want to talk about the overall bullish or bearishness. Okay, there are also other indicators. Okay, but for this, I just want to talk about this one. If you want to know more about MACD, you can always refer to other videos. Okay, due to the time constraint, I just want to extract the info that I want, because out of so many indicators, there are so many indicators in the list. So I have to be clear. If I want to know the volatility, I go to ATR. If I want to know the overbought and oversold, I go to stochastic and RSI. If I want to know the bullishness or bearishness, I go to MACD. So that means I must know very clear what I want first. Then I will go into that particular indicator to extract the kind of information that I need. Okay. Otherwise, if you straight away you throw in like MACD, stochastic, RSI, a whole list, and then you get crowded your mind, and then you cannot make any decision because it is very confusing. Okay, so you have to be very careful. You must extract the right info for the right purpose. Okay. Then on balance volume is a volume bar. Okay, so basically it is calculated using the up day volume minus the down day volume. So for the past accumulative, this one is accumulative. So for the past accumulative, you are using all the accumulation of all the up day volume, the price times the volume, minus the down day, the price times the volume of the negative days. So if you have going up, rising up, that means it is upward. Okay, and then if let's say it is going down, that means it is selling down. So you can see that this OBV, it will follow this price going up, and then when it go down, it will go down, and then when it go up, it will go up. Okay, so it's just a confirmation of the trend. Okay, on balance volume, it's just a confirmation of whether it's a bullish trend or a bearish trend. Okay, then number 5 is very important. It's about the volume. If you are talking about the derivative market, you have the open interest. Okay, so let's talk about the open interest first. So this one is a derivative market where I look at the FKLI, whereby I use the current month. If you use the current month, you can see that the open interest will go to 0, because for end of the month you close the position. The FKLI.
Okay. I
Okay.
took over.
So sorry. So yeah. So sorry. Just now I saw my battery low, but then I thought I was able to do. But anyway, we're about to continue on the last few slides here. Okay.
But we can't see your webcam anymore, right?
You can't see my webcam?
Yeah,
Oh.
I'm not seeing your webcam. But it's
No one
alright.
can see. Mm.
Oh yeah, now you're back. Now you're back.
Okay.
Okay.
So sorry. Okay.
Okay.
Now
Let's talk about open interest.
So now, because the open interest, right, every month end is ending. So you can see that the open interest will close, so it'll be 0. Okay. So then usually for the CPO, you look at the forward month. Okay, forward month, then you can see that it is rolling. So what this open interest means is that there's a definition here. Open interest is the total number of contracts that remain open and held through at least one trading day. So that means your open interest is being open is because you buy the contract and then you leave at least one day. Okay, you hold at least one day, then it becomes one of the volume in the open interest. So if let's say you on the same day you close, you buy and then you close the position, then it's not in the open interest because it's not like more than one day. Okay, so if you buy and sell within one day, it is not considered your open interest. But if it's you buy the contract and then you hold at least 1 day, then it's considered the open interest. So that means this open interest tells you how many people are willing to hold on to the position. So that means the people are willing to be interested in the particular contract. Okay, so you can see that the open interest, usually what I will look for is extremely low open interest. Whenever you have extremely low open interest, that means the trend is changing. Okay, so either it is an uptrend or a downtrend. When you see extremely low, the trend is changing. And then when you see that it is low, the trend is changing. When you see this low, and then you see the trend is changing. This one is from here up to here, from up to down. Okay, so I usually look for very low open interest. Okay, then the volume. The volume is the total number of shares traded. So of course, this one for equity investors, you are very familiar, because this volume tells you about the daily volume. So if let's say the volume is increasing, it means that that particular day, if let's say the price more than 1%, it means that people are bullish about that particular stock. Okay. However, if let's say the price is falling, and then the volume is also rising, that means a lot of people are selling. So then this tells you the sentiment about that particular stock by the volume. Okay, the volume will tell you the sentiment. That means people are participating in that particular stock. Okay, and then always we have to have good trading habits. Okay, in order to know ourselves and in order to know the market well, we need these two combination. And in order to combine these two combination well, we must have good trading habit, because when you have good trading habit, you understand yourself, you are disciplined, and then you are able to understand the market better. Does that make sense? That means you understand yourself better before you understand the market. So always have a trading plan before you trade. Okay, because the trading plan will tell you what price you enter, what price you're going to exit, and what's your risk and reward ratio, and what's your risk management plan. And then number two, you keep your trading diary. That means you have to make a journal or something, because for example, when you buy, you have to sell. Why do I buy? What's the psychology behind it? And then when you sell, why do I sell? So all these are to keep track of your psychology, emotion when you buy and sell. It's more this is actually more towards the traders. And then you exercise on a regular basis to develop a disciplinary habit, because when you look at exercising, it's actually a test of your discipline. People who are disciplined, they will regularly go on exercise, and then it's only this disciplinary habit will make you be successful in the stock market or in the trading world. And then you have to stay focused to your trade. If you have no time, do not trade. And most important, you have to practice, practice, and practice. Okay, because if you just once in a while you buy once and then you forget about it, then you are not practicing, and then you are not taking track of your emotion, and then you are not learning. So when you practice, that means you are learning from your experience. And in summary, today we have done a lot. We have talked about the mental bias from the theory perspective, and then how we apply it. Remember the prospect theory, whereby people hold on to the sell the winners and hold on to the losers, and you know why? That's because of the prospect theory. And then we are looking at the different market information to influence investors' behavior. And then we also look at the how we need to understand ourselves through certain risk profiling tests, or understand yourself. Try to find out more about yourself first, and then before you find out the market. And of course, when you need to find out about the market, you rely on indicators, okay, technical indicators, because when you apply the technical indicator, very important that you must know what you want to extract from the market first. If you want to know about whether this particular stock is overbought, oversold, you know which indicator to buy, which indicator to look for, which is the stochastic and the RSI. If you want to know the volatility of the a particular stock, you look for the ATR. Okay, so you must know what you want to look out for. Okay, then of course the most important is a good trading habit, and that will enhance our trading performance. Okay, so I think that concludes my presentation for tonight. Yes, now it's a Q&A session.
Yes. Thank you so much,
Yeah.
Pauline, for your wonderful sharing on mental bias and how
Yes.
we can stay rational in a irrational market. So the first question on our screen right now is, um, can we summarize that heuristic is equal to sixth sense?
um, it is part of it is sixth sense, and then part of it is more like automatic response, very quick response. Okay,
Mm.
sixth sense is more like a intuition, okay, intuitive, and then another part is because you must have the experience. Okay, it's like an automated kind of action. So
Okay.
yeah, it's part of it lah. Yes.
So the next question is, how do I avoid self-sabotage where I don't follow my own plan?
Self-sabotage. Oh, how do I avoid?
How
You
do I
have to.
avoid self-sabotage?
Okay, if you cannot avoid, that means you are not disciplined. So in order to be to prevent that kind of a situation, right, you have to be religiously telling yourself you need to follow the plan. So that's why,
Religiously.
yeah, that means
Okay.
there's like, okay, when this thing hit the price, I must do certain action, because very often you will tend not to do, and because of your another thinking. So that's why you have to tell yourself that you have to be disciplined. So in the end, it's the word discipline issue come in. You are not being disciplined. Yeah. So to avoid
So
that, you have to
need
be
to
disciplined.
build out discipline.
Yes.
Uh, okay. So next question is, uh, how should one react if the
Mm.
IPO performance looks very attractive, and so understand like how long can it sustain? For
Mm.
example, recently we have SolarVest who go IPO,
Mm.
and then performance was exceptional. But
Mm.
how should one react if should we follow
Actually,
or should we not follow?
because IPO is a bit tricky because they do not have a track record. I can't even tell the chart. There's no track record. So therefore, for IPO, it's really tricky. It's I would say that the fundamental boils down to the fundamental of that company. If it's really good fundamental, you you may follow the trend. If however you think that it's not, the fundamental is not that strong, then perhaps you just don't look at it anymore. Yeah, just let it run. If it run, you just let it run, because if you believe that it is not so good in fundamental, you just close your eyes, don't look at it. Yeah.
Okay. So the next question is, would you say that midterm investment strategy require more risk taking than intraday trading strategy? Does
um,
greater bias exist in this case?
it's a very tricky question, because sometimes a lot of people, they say, oh, trading is very dangerous. However, if you look at trading within a day trading, you are limiting your position within a day. In fact, you don't let it run overnight. You are reducing your risk. So it could be the day trading is less risky than the medium term trading. It depends on how you look at it. So if you are looking at medium term, because the number of days out there you are exposed, your stock or your risk is more, because it's medium term than the short term. Yeah, there's in terms of the exposure of the number of days is more risky. But however, it also depends on what stock or what fundamental that particular stock is. So if it's a good fundamental stock, I would think that medium term is still okay. It's not risky. So whether risky or not risky depends on the nature of the stock. I would think like that. Yeah, the
Mm,
nature of the stock.
mm,
Good
okay.
fundamental stock will be less risky. regardless of the time frame.
Okay, I see. The next question is Mr. Kun Yu Ying, which I believe you would know him, always prefer to buy stock with high volatility. His argument is that it's easier for him to sell when he wants to. So the participant asks you, what do you think about that statement?
That means he probably was buying into penny stocks, or maybe those stocks that are less than like $1 or $2 kind. Okay, so it could be very volatile. So, but I wouldn't. It depends on what you want to buy. If let's say you want to, your risk appetite is like a more towards the high risk. So of course, the high volatility to you is to your better advantage, because you can buy and sell. Are you referring to the equity market or the derivative market? Probably he's referring to the equity market, is it?
Yeah, equity market.
So most likely he's referring to when the price, due to favorable news, it jack up, and then he can sell or whatever. I'm not sure. So yeah. So it's hard to say answer that question actually. High volatility, because to me, it depends on back to the fundamental, whether whether it's risky or not. Because the volatility, it could be due to your demand and supply. Whether, if you have money, you can, because the what drives the price. Of course, the fundamental will drive the price, but another way of looking at it is the demand and supply. Demand and supply is based on how many people buying, how many people selling. So if there are more people, you have more money, the price can go up. Yeah. So.
Okay. Let's do one last question. Is how do one regain trading confidence when we have been irrational or after we cut loss?
Yeah, actually, this is a very difficult part, especially when you are starting to be a trader, and then you want to do well in this field, and very, very often you will come into cutting loss. And for a start, you may feel that this cutting loss is very heartache, because you feel that you are losing a lot of money, and then you lose, not only you lose money, you lose your confidence. So every time when you cut loss, and then you lose your confidence, and then the next trade you are become very reluctant to get into the market. So one way I look at it is that perhaps you can reduce your position size, like into one contract. So if you lose money, you lose a little bit, so that your confidence will slowly gain, and then when your confidence is gained, then maybe you can increase your position size, or your number of quantity. So you start with a small quantity, back to the small quantity, one lot, or one contract, or a small quantity first, so that when you lose money, you don't feel so much heart pain. Yeah.
Okay, I see. So thank you so much, Pauline, for sharing with us your idea about how do we stay rational in an irrational market. So let me take over the control right now. Okay. So again, if you have not registered for our news analysis in Mandarin next Tuesday, please click the link in the chat group to register for it. And then with that, I want to thank all of you for being a wonderful audience online, for being patient with us while we have some technical glitch just now. So
Yeah.
thank you, Pauline, for tuning in today to share your nugget of wisdom with us about mental bias, to talk about behavioral finance. Today I've learned a few new terms that I've never heard before and to share with us how can we stay rational in this market. All right, so for the rest of you, I wish you a great rest of the evening, and I'll see you again next Tuesday. Bye bye.
Okay, bye bye.
Bye bye. Bye bye, everybody.